Dear friends of the Swiss Chamber of Commerce, dear members, distinguished guests, it's a pleasure to welcome you to this last webinar that we are organizing this year during the year, which has been quite special for the whole world, and we are hoping to open a new window on 2021 now, talking about automatic exchange of information, especially on a focus on the relationship between Switzerland and Turkey. We already have an impressive number of attendees joining. Thank you for making it. It's a pleasure to have you with us. And I think it reflects the importance and the accuracy of this topic that we will be addressing today. Automatic exchange of information was already a matter that we had been, as a Swiss Chamber of Commerce in Turkey, addressing a few years ago when the whole debate all started. And back 5 or 6 years ago, we already had two of the panelists joining us today, Sedat, Eratalar, and Mr. Bertrand Binggeli, who at that time were already at the forefront of the discussion, and we thank them for joining today again. Today we indeed have quite a rich panel of experts and speakers, both from Switzerland and from Turkey, representative from the banking sector with UBP and Banque, as well as tax expert from PwC Turkey, all moderated by Mr. Sedat Eratalar, who's one of the most experienced tax advisors in Turkey, both on local and international tax, advising numerous multinationals and individuals in Turkey relating to local and cross-border taxations. So I will now leave the floor to Ms. Ariane, who's the head of the Economic and Cultural Affairs at the Swiss Embassy in Ankara. Ariane also made us the honor of being with us to briefly address the position of Switzerland in this process. So I'll leave the floor to Ariane and wish you all a very fruitful discussion today. Thank you for joining.
Well, thank you, Arpat. Good afternoon. Also a warm welcome from my side to our webinar about the automatic exchange of financial account information, short AEOI, between Turkey and Switzerland. My name is Ariane Tinner. I'm the economic counselor at the Swiss Embassy in Ankara. And I would like to give you, after a few general remarks, an introduction on the implementation of the AEOI in Switzerland, and also on the process and the timeline for the activation of the AEOI between Turkey and Switzerland. Well, the economic relations between Turkey and Switzerland are very good. Switzerland is the 7th biggest investor in Turkey, and the interest of Turkish individual investors in Switzerland is high due to the economic stability in our country. As you know, Switzerland has a very good reputation in banking. Swiss banks stand for stability, excellent quality, and a high level of data protection. So what does the AEOI imply, or what is the purpose of the AEOI? To protect the bank client confidentiality and to ensure at the same time that there is no misuse or avoidance of a foreign tax system, Switzerland adopted the standard of the automatic exchange of financial account information in 2017. The OECD standard on the AEOI is an important step towards international tax transparency. Switzerland has committed itself to implement the AEOI in conjunction with all relevant financial centers. According to the AEOI, precisely defined information, for example, bank account balances and income from assets is routinely transmitted to a partner country every year. The tax authorities can use the information exchanged to check whether the taxpayers are submitting their tax revenues truthfully. In the panel later on, you will hear more about which data will be exchanged. But when and how has the AEOI been implemented in Switzerland? The legal basis for the AEOI in Switzerland came into force on January 1st, 2017. With a first batch of 38 countries, Switzerland has already implemented the AEOI as of that date. Switzerland has currently introduced the AEOI with 97 partner states and territories. In 2020, Switzerland exchanged data on financial accounts with 86 partner countries. The inclusion of further states and territories in the AEOI network serves to guarantee equal competitive conditions, a so-called level playing field, and secures the position of the Swiss financial center and ultimately the entire business location. Switzerland consistently applies the relevant agreements, which means that in the event of non-compliance with the agreements by a partner state, Switzerland will take the countermeasures provided for in the agreements, which can be the immediate suspension of data exchange, which means if Switzerland has already activated the data collection and exchange with another country, if that country doesn't deliver the data, Switzerland can suspend the exchange of data. But where are we in the adoption process, and what is the timeline for the introduction between Turkey and Switzerland? In Switzerland, the introduction of the AEOI with each partner state requires the approval of the Swiss Parliament, both chambers. In principle, Switzerland implements the AEOI with all partner countries that meet the requirements of the global standard and express their interest in the AEOI with Switzerland. They are called appropriate interested partners. Turkey notified its automatic exchange of information partner states, including Switzerland, in February 2020, this year, to the OECD. Later on in the panel, our Turkish colleague Baris will tell you more about the process in Turkey. Since the Republic of Turkey meets the requirements of the global AEOI standard, and Turkey has already shown its interest in the AEOI with Switzerland, the Swiss Parliament has decided to introduce the AEOI with Turkey in March 2020. Switzerland will notify Turkey as a partner state to the OECD within the next 2 weeks, which means before the end of the year. The AEOI with the Republic of Turkey will thus be introduced on 1st January 2021 on the basis of the relevant multilateral agreements, which means the data collection will start next year. The first mutual exchange of financial account information in accordance with the OECD standard will take place in autumn 2022, based on the data collected in 21. Under the AEOI, the clients of Swiss banks will still continue to profit from high standards, excellence, and traditionally high data protection for tax-compliant assets. The introduction of the AEOI between Switzerland and Turkey brings both countries closer to the goal of equal competitive conditions, the so-called level playing field, and the principle of fair taxation. I'm looking very much forward now to our panel discussion, and I'm also very keen on learning what it really means for bank clients on both sides in practice. May I give the word to you, Sedat Bey? You're, as Arpat already said, also an expert in tax law, a founding partner at Eratalar Management Consulting, and our knowledgeable and distinguished moderator today. Thank you very much.
Thank you, Ariane. Thank you for your very nice and valuable introduction. You have already explained most of the valuable part of the Switzerland in relation with the automatic exchange of information. And good afternoon for everybody. And I also would like to thank to Swiss Chamber of Commerce and Swiss Embassy. We are four panelists today. I'm not going into detail, explain their experiences and etc. because you all see their CVs on the screen. And automatic exchange of information is part of the CRS, Common Reporting Standards, which is an issue since 2011. Because the main agreement has been signed between the OECD countries in 2011, and 2016 is the first part. The beginners, as the countries they have started, and 2017 is the other part under normal circumstances. Should be started for the sharing of the financial informations. And we came today, and as today, we will be concentrating the automatic exchange of information between Switzerland and Turkey. And there is a two-part in this panel. The first part is Swiss part. We have two Swiss guests. They will explain us, introduce us, how this exchange will be taking place in Switzerland, what kind of information will be provided, and etc. and etc. And we have two panelists, as I told you, in this from Switzerland. One is Mr. Bertrand Binggeli. He is the Executive Director, Wealth Planning Group Head of Union Bank of Privée, UBP. And Ms. Danute Rico Slotkus. She is the Senior Wealth Planner, Banque, Switzerland. And now I don't like going into detail, and we have a limited time. For that reason, I pass the floor to Bertrand. Thank you.
Thank you very much, Sedat. Very good afternoon also from my side. It's a pleasure to join you today. Thank you again for organizing this event. Thank you to the Swiss Embassy, of course, the Swiss Chamber of Commerce in Turkey. It's a welcome opportunity and a timely opportunity to look at the standard, the automatic exchange of information, financial account information in tax matters. Actually, that's the real wording of the topic from a Swiss perspective first. A little bit of a background before we really dive into the technicalities of the classification of the different accounts and trying to answer actually who reports what and when. And that's, I think, very much of essence to all of you. The standard has been developed in 2014 by the OECD based on a call of G20 leaders. So you can already understand that it comes from very high. Turkey is part of the OECD member club. And it's only natural, I would say, that Turkey now joins that club and make it effective. The standard for automatic exchange of financial account information contains actually a set of regulations and rules which tells who should report, what should be reported, and when. And when we say who, what, and when, we of course try to define who are those who are under a duty to identify reportable accounts. That's important. Which accounts are to be reported. And then, of course, Danute will guide you into the technicalities in a minute of how to classify those accounts. Relatively easy for individuals, less easy for legal entities, to say the least. And the type of information depending on the status of the reporting accounts identified previously. Those are part of due diligence rules, and that's important to understand for everyone. The standard is common. Common meaning that every jurisdiction has adopted more or less the same rules in terms of identification of accounts which need to be reported, how to classify those accounts, and what type of information should be exchanged. Turkey is now joining the club. We have already experience with other jurisdictions, actually, for a couple of years. So Turkey is one more on the list, I would say. Not really new, and you can definitely learn from our past experience with other jurisdictions. Important to understand that the due diligence rules is not something easy to handle. Number one, you will understand that in a minute. And number two, we are under supervision by our Swiss regulator on how good we are in implementing those rules. And not only the regulator, Swiss banking regulator is watching on financial institutions in Switzerland, but also the tax authorities. That's important to stress at that point, that the Swiss tax administration will make and undertake audits to ensure that every reporting financial institution in Switzerland comply with the due diligence rules. So it's not on a discretionary basis, it's really mandatory that we have to follow those rules. So that's important and mandatory, actually, especially nowadays, since many states, probably including Turkey, are trying to collect more revenues given the very special period we are in. Danute, may I ask you to now guide us into the technicalities on the different accounts involved and how they are going to be classified?
Sure. Okay, so good afternoon to all of you. It is a real pleasure for me to be here. Thank you for the Swiss Chamber of Commerce in Turkey for this great organization and kind invitation. And now, without further waiting, let's tackle the technicalities, if I may say. Basically, in a bank, we have accounts either held by an account holder who's an individual or an account holder who's an entity. Let's try to simplify it as that. If the account holder is an individual, it is straightforward, very simple. The bank, as a responsible entity, we will enter afterwards with the right names, will report the information on the individual. Now, on the entities, unfortunately, there is a bit further analysis that is required, and we need to enter into some classifications, if I may say, to see who is reporting, who is reportable, and what is reportable. So basically, within the entities, I'll try to do it on, as simple as possible, but bear with me, there are technical names. So let's continue. Basically, once we have an entity, the first question that we're going to ask is it what is defined within the CRS or the Automatic Exchange of Information Regulations, a financial institution. So what is a financial institution? Basically, a financial institution is, in simple words, is a custodial institution, a depository institution, is a management investment entity, it's a special insurance company. So it's, I mean, the definition is quite large, but the first question is it a financial institution, yes or no? If it is a financial institution, most likely it will be one of those reporting financial institutions or FIs. And there, this FI will need to report on itself and most likely on the relationships or the clients. So is a bank a reporting FI? Yes, we are reporting FIs and we will be reporting. It's our responsibility, as it has just been mentioned, and we are considered one of those. Now, there are some financial institutions that are considered non-reporting, but we are not going to cover those today as they are, let's say, out of scope. For instance, what would be a non-reporting financial institution? It will be like a central bank, a pension fund, or governmental financial institutions or things like that that are out of scope. So we are not gonna tackle that public. Now, if we get to the conclusion that the entity account we're dealing is not a financial institution, then it is a non-financial entity or an NFE, basically. Within the NFE, we have two types of NFEs. Why is it important? Because the scope of the information that will be disclosed will change depending on that classification. So if we have already excluded financial institutions, now we come to a non-financial entity. So the first question, is it an active non-financial entity? What is an active non-financial entity? Basically, it is a company, it is an entity that has less than 50% of its income is passive, meaning it is more than 50% is active. It has a real activity, either by, I mean, that's one of the classifications, being by income or by assets, or less than 50% of the assets of the entity are used to produce passive income. So for instance, if we have an entity that its only sole purpose is to hold assets that produce passive income, being that interest, dividends, royalties, so it will not be considered an active NFE. Now, there are other criteria to be considered active NFE. For instance, a publicly traded entity or a company related to a publicly traded will also be considered an active NFE. There are other types of classifications, like a startup or some other public entities or international organizations could be considered active NFEs. Now, if we get to an entity that cannot be considered an active NFE, therefore, it will be considered a passive non-financial entity. That is like if we are not a FI, if we are not an active NFE, we are a passive NFE. Then, why is it important? Because we will see that the information reported is different. So just to answer who is responsible for doing the reporting in this slide. So if it's an individual account, is the bank. If it's an entity that is classified itself as a non-financial entity, active, is the bank. If it's a passive NFE, also the bank, but you'll see that it's a small line saying controlling persons, and actually we will detail that later because that's very important. A passive NFE, it's reportable as a look-through entity, and that's why we need to look further who is behind the entity. In an active, it will be considered the entity itself. Now, if it is a financial institution, then the reporting entity will be the financial institution itself. So that's why, so how do we know if it is an active, a passive, a reporting? Basically, the entity itself will confirm to the bank which is its classification. So that is why it's so important to start with these technical words. If it's an active, a passive, an FI, that will determine who reports and what is reportable. So if we can, and well, here we will get back later on. So if we go to the next slide, I just wanted to start what is reported. So basically, if we start for individuals, I know this is some very sensitive information. So I have decided to split those, like for discussion purposes, in what is personal data reported on financial data. It is not defined as such in the law, but it's just for you to understand, and because I'm going to use those later on. So basically, if an individual holds an account in a bank in Switzerland, what will be reported to our tax authorities that will then forward it to the Turkish tax authorities will be the account number, the full name of the account holder, the tax identification number of that account holder, of course, the country of tax residence, which will then determine to which country the Swiss tax authorities will exchange, its address, the name of the bank. Basically, all this information, either the bank already has it, or will ask the individual to sign a document that we call self-certification, where he will confirm this information. So that is on the personal side. Now, there's also financial data, of course, exchanged. And basically what is exchanged is the total assets at the end of the year, dividends received during the year, interest received, other income, assets sold, the currency, detail of transactions generating those amounts. And for your information, all this data is exchanged in a special encrypted file that is sent in the same format by every single financial institution to the tax authorities, and all the countries follow more or less the same, they have to follow the same format. Just one little detail, which is important to bear in mind. Whenever we have a joint account or a collective account with several account holders, remember, please, that the information reported is on all the account holders, and there is no report on percentages or saying, okay, to this one I report 50 or that one I report 30. It's reportable on 100% for each of the account holders. So that's like the easy part. Now, if we go to the next slide, we see what is reported at the level of the entities. So if we see, do you remember that we were talking about, is it a financial institution or is it a non-financial entity? Then for an active non-financial entity, what is reported is the entity itself, as like the personal data will be the personal data on the entity. So the entity's name, its tax residence, if it's any corporate team, and its financial data. Now, if we go to a passive non-financial entity, as I have already mentioned, this entity is looked through. So we will report on the entity, the entity's name, and so on. We will report on controlling persons, the personal data. The term for these regulations of controlling person, the concept is quite important. So it depends who is a controlling person, will depend on the type of entity, whether it's a company, whether it's a trust, whether it's a foundation. We will see that just in a few seconds. And then there is all the financial data, of course, that is exchanged. Now, if you allow me, when we are having an entity that is a reporting FI, the reporting, as mentioned already, is not done by the bank, but is done by the entity itself, because it is a reporting FI. So, for instance, we have an account opened by an insurance company for an insurance policy for the benefit of a client. Then the insurance company will do the reporting on that client. Or if we have an account open on the name of a trustee for a trust that was set up for a client, and that trustee is himself a professional trustee identified as a reporting financial institution, then the trustee will do the reporting. But again, it depends on the classification that the entity will have been given to the bank. Now, there is one little box that is called a financial institution as well. So we said the principal financial institution, it reports itself, but if this financial institution, being, for instance, a trustee managed by a professional trustee, but that is based in a non-participating jurisdiction, for instance, a trust or a foundation set up in Liberia or a country that is not yet participating, it will be considered from a bank point of view as a passive non-financial entity and therefore reportable in a look-through manner. Okay, basically that is what is reportable. But then, of course, the question is, how do I know if I'm a controlling person or not? So that's what we're going to see in the next slide, which is who is a controlling person for a company. So basically, a company will determine its controlling persons either by ownership or either by another type of control or either by its managing officials. So those will be identified as the controlling persons and therefore reportable when the account is held by a company that has been classified as a passive non-financial entity. So bear with me with the technicalities, but basically this is quite important. Then if the account is held on the name of a trust and the trust has not codified itself as a financial institution, but as a passive non-financial entity, the bank will ask to identify the controlling persons, being it the settlor, the trustee, the protector, the beneficiaries, and any other individuals that could have another type of control within the trust. Let's say a specific position that has a specific power, or so on and so forth. Now, when we talk about a foundation or a similar legal construction, who is a controlling person? It will be a founder or settlor equivalent, directors, protector equivalent. So all those are controlling persons that will be reported by the bank. So I believe I have more or less covered the technicalities. Thank you for bearing. And if you don't mind, maybe Bertrand, I don't know if you want to say a few concluding words on the Swiss technical part.
Sure. I hope you can hear me. Maybe a couple of words about the type of attitude we have seen from a client's perspective, also based on the past experience we had with other jurisdictions. First of all, the very first attitude we have seen with our clients is that they try to deny and ignore what's happening. That was probably the case a couple of years ago. That is gone, hopefully, with most of them. Then we have seen a couple of clients trying to play around the new rules to the extent they understand the new rules, of course. And I think the current trend is more facing reality. And that brings me back to the ultimate goal of the Common Reporting Standard as defined by the OECD. There should be no way to escape, no way to hide anything from the reporting jurisdictions. That's the ultimate goal. And again, if you link this goal with the fact that we as financial institutions will be audited, not only by the Swiss tax authorities, but also by the Swiss regulator, at least for the banking sector, we have no choice to be very strict in the way we will implement the rules and we will practice the rules. Now, a couple of words about individuals and legal entities. For individuals, it seems relatively straightforward, and Turkish clients need to understand that they will have to sign new forms, self-certification forms, confirming to the bank that they are Turkish residents. And they should also indicate, as the case may be, any other tax residency they may have in addition to the Turkish one. So basically, that form is an important form. It's a legal title. And of course, any attempt to play around with an actual tax residency in a specific jurisdiction is something which will be fined afterwards and will definitely jeopardize the banking relationship, putting basically the bank in a position to warn the client that should that self-certification be inaccurate, the bank will be forced to close the account actually and to stop the relationship with a client. So that's a very important step to bear in mind. So full tax residency needs to be declared via the self-certification form. With regards to legal entities, as you have seen via the really brilliant slides presented by Danute, this is a relatively complex, right? Because there are apparently ways to try to circumvent a little bit the reporting duty by shifting the same reporting duty from the financial institution, the bank, to another professional. That is the corporate director of a company, the trustee of a trust, or the board members of a foundation, for example. There are different ways to do that, by using a professional provider or by granting a discretionary mandate when it comes to asset management purposes. Clients need to understand two things here. Number one, there is no way that a bank will allow an undue shift of reporting duties from the bank to another provider, meaning that it has to be supported by a genuine setup. That's number one. Number two, the shift doesn't solve the entire issue, because even if the bank is not in a position or under a mandatory duty to report, the structure itself, the company, the trust, or the foundation, has to do so. And even though the scope of information exchange may slightly differ, there will likely be a real actual exchange of information. So it's an absolute mistake to think that by using companies, for example, with corporate directors, granting a discretionary mandate in terms of asset management to a bank, that will solve the issue and basically prevent any actual exchange of information with Turkey. It is wrong. Also, again, the scope of information to be exchanged may slightly differ. To that end, talking about the scope of information to be exchanged, I think it's also worth mentioning here that the scope of information sent from Switzerland to Turkey may definitely differ from what a Turkish resident taxpayer needs to report in his or her actual annual tax return. To give you a very simple example, when it comes to gains realized on the sale of a security, usually you only report the gain realized, which is the difference basically between the acquisition cost and the sale, proceeds of sale, within the CRS mechanic, the entire proceeds of sale will be reported, exchanged. So you see that that will easily lead to further audit, queries, questions from tax authorities, as the case may be. And I guess our distinguished speakers from the Turkish side will expand further on this later. But that will likely lead to situations where taxpayers will have to explain the difference, will have to provide additional documentation, additional explanation, additional information to basically accommodate the Turkish tax authorities. So this is where I think we can make the bridge with the Turkish part of this topic And of course, more than happy to answer any question going forward. Thank you very much.
Thank you, Bertrand. Thank you, Danute. Very valuable information from Switzerland. You have explained in detail who is responsible for reporting in line with the Swiss authorities and what kind of information will be reporting, mainly depending on the type of the account holder. If it is a Turkish individual as account holder, definitely the bank is responsible for reporting all these datas. And in case that the account holder is an entity, then it is more detailed. Then depending on the active or passive type of account and the management of this company, whether it's a financial institution or non-financial institution, this will be mainly investigated in detail. And as you said, Bertrand, the Swiss tax authorities, they are very keen. I mean, very strong compliance and control methodologies on the banks, on the financial institution. And you also said that for the account holder, Turkish account holder, I mean, and the banks or financial institution will request a kind of residency form showing that their residency, whether in which country they are a full taxpayer. And those are the things I get the notes. And we will be having, still we are getting some questions. And after finalizing our Turkey part, we will start, I mean, the answers. And in this part, Mr. Baris Hincal firstly will give us some information and explanation in the relation of the automatic exchange of information from Turkey side. He is the financial service senior manager in PwC, PricewaterhouseCoopers. And right after Baris, I will do some kind of introduction related to the asset amnesty, which is a new rule, as most of you know. And afterwards, we will start these answers. Baris, it's your turn.
Thank you, Sedat Bey. First of all, thanks for joining to all participants. Hope it's going to be helpful to every participant and every financial account holder in this webinar. The definitions of financial institutions, financial accounts, and the data to be shared are almost the same with Switzerland. So I think we do not need to double it for Turkey. So let's start with the Turkey's current position in the CRS. As you know, a communique on automatic information exchange, we call it the secondary legislation, had been expected to be issued for the entire automatic exchange legislation to become effective in Turkey. This draft communique that was open for the opinion of financial institutions in May 2017 has not been published yet. While we were waiting progress on this draft communique, a guideline has been published in August and has provided us with the expected important information about Turkey's position in the CRS. This important information was the reporting will be made in 2020 regarding the information for 2019. Please here note that the years period to 2019 are not in the scope of the information exchange. And secondly, this information will be made bilaterally with 54 countries and unilaterally with 70 countries. These 17 countries will supply account information to Turkey, but will not receive such data. This is because some of them have declared themselves to be permanent non-reciprocal jurisdictions. Some do not comply with the confidentiality and data security requirements, and some have not yet submitted a full set of notifications, either because they are still in the process of adopting domestic legislation, or because they are still putting in place operational and IT framework, in particular, to implement the required standards on confidentiality, data safeguards, or and the proper use of the information. And here, also please note that these 17 countries do not specifically reporting to Turkey, and this unilateral reporting is applicable to many other partner jurisdictions like Switzerland. I mean, that's not specific to Turkey. First reporting by the Turkish revenue will be made by the end of December this year, and this deadline will be the end of September in the upcoming years. And as you see here on the screen is the list of the countries that Turkey is starting exchanging the financial information automatically. As you see, Turkey's biggest trading partner, Germany, and other jurisdictions with the highest population of Turkish citizens like Belgium, Netherlands, Austria, France, are not among those starting the information exchange this year. And unlike Switzerland, we still do not know when the exchange will start with these jurisdictions. However, as per some verbal information of the officials in the revenue administration that we have been provided recently, we understood that Turkey notified Switzerland as a partner jurisdiction and will possibly start exchanging information of 2021 starting in 2022. And we can move forward to our next slide. Then I want to talk about the tax residency, which is one of the most important items in the CRS world. So I often see that the people become confused about the distinction between the residency and the citizenship when it comes to CRS. I think I should here state that CRS looks at the residency for tax purposes, not citizenship. Tax residency is determined under the domestic tax laws of each jurisdiction, and there might be circumstances where a person qualifies as a tax resident under the tax residence rules of more than one jurisdiction, and therefore he or she becomes a tax resident in more than one jurisdiction. And this may, of course, be the case for Switzerland and Turkey as well. In such cases, the double tax treaties between these two countries should be checked. Firstly, if we look at this from a Turkish perspective, those whose domiciles are in Turkey and those who stay in Turkey continuously for more than 6 months in one calendar year are considered as a Turkish tax residents. This is the common local rule in Turkey. And those who are detained or stay in Turkey for various reasons beyond their control, like illness, like conviction, or some businessmen who come to Turkey on a given or temporary mission, are not considered as tax residents. And for Switzerland, according to the information provided in the OECD sources, we understood that an individual is a resident for tax purposes in Switzerland if he or she maintains a tax domicile or a place of abode in Switzerland. As to the term tax domicile, it means if you are living in the country with the intention to stay permanently, then it means you establish a tax domicile. On the other hand, if you establish a place of abode, if a stay of a minimum of 30 days includes a gainful activity, or without such activity if the stay is 90 days at minimum. Again, as to our research in the OECD sources, we understood that the Swiss tax authorities may interpret this gainful activity, whether employed or self-employed, very widely. And as to our knowledge, any activity which would normally be remunerated can be considered as gainful activity. So this is one of the important points maybe we have to emphasize here. And again, like it is in Turkey, in Switzerland, the stay solely for educational and health reasons is not considered as satisfactory for tax purposes. If we assume that you satisfy the conditions of being resident in Turkey and being resident in Switzerland, according to their domestic rules, we have to refer to the provisions of the double tax treaty between Switzerland and Turkey. The criteria to be checked respectively will be the permanent home. Firstly, if there is a permanent home in both countries, then the country with which the personal and economic relations are closer is the answer to the tax residency. If it cannot be determined and no permanent home is available in both countries, the country in which you have habitual abode is taken into account. Habitual abode basically simply refers to the period of time a taxpayer spends in each country. And if you have a habitual abode in both countries or in neither of them, then nationality takes place in the determination of the tax residency. And lastly, if you are the citizen of both or neither of them, Turkey and Switzerland should settle the question by a mutual agreement. When it comes to the determination of a company's residence, we can say that the capital companies and commercial enterprises are considered as resident in Turkey if their registered head offices or business head offices are in Turkey. Thus, if you have an office in Turkey in which your business transactions are conducted, then the office is deemed to be a Turkish resident. And in Switzerland, an entity is resident for the tax purposes if its registered office or the place of effective management is located in Switzerland. And here we have to note that if an entity is incorporated outside Switzerland, it may still be a Swiss resident entity for tax purposes, of course, if its place of effective management is, where the important decisions are taken, then this means this company should be deemed as a Swiss tax resident. Here is another important point that I want to mention here. For the purposes of CRS, the account holders must disclose all their tax residences in the required self-certification form, and financial institutions must ensure that these are disclosed by the account holder. The bank normally contact the impacted customer to obtain a self-certification form in which they determine their residence for tax purposes and provide their TIN, that we mean the tax identification number. Without a self-certification, the bank is probably legally obliged to consider the customer as a reportable person. What happens if you do not complete the self-certification and other required forms, or do not provide the required information? The bank may be obliged to decline any requests for new accounts, as Bertrand told in his while he was talking. And the bank may decline any further transactions for the existing clients that do not provide a completed CRS self-certification form. And if you do not respond to the bank's request for a self-certification, and depending on the details on your record, the bank may need to treat your account as a reportable account again. And as a final note, I would also like to remind you that there are cases where the customer declared incorrect residences intentionally in the self-certification forms. In such cases, since the bank may contractually hold the right to recourse any potential penalties stemming from the customer's false declaration, you may be faced with penalties. So you have to be careful, and you have to determine your tax residency in detail. You have to look at every sources. You have to maybe consult to your tax advisors personally when you determine your tax residency. So that's what I want to tell from my end. The important topics that I want to mention was the tax residency and Turkey's current position in the CRS.
Thank you, Baris. You have very clearly explained about the Turkey side, Turkey in which position in line with the automatic exchange of information, and about the tax residency and the double tax treaties. One thing I would like to add, the Turkey part, or the exchange of the information from Turkey to Switzerland, which is not clearly updated in the OECD website, but several times we checked that one, and Turkey tax authorities, they confirmed that we have activated, Switzerland starting from 2021 for the sharing of the financial information. The activation system of the countries are different. For example, Switzerland do the activation through a passing parliament decision. Turkey do it with the information from the Minister of Finance to the OECD, even not necessary to have a kind of presidential decree in Turkey. And as Baris explained, that we have a list of countries that we have decided to share the information, and this is our all of with the notification by the Minister of Finance to the OECD. Now, my part is very quickly, because we have many questions in relation of this explanation. The asset amnesty, which most of you having idea about that, because really I didn't count that how many times we did the same or similar type of amnesty, maybe 9 or maybe even 10. And the last one ended this year, end of June. And now in November, with some other issues, the similar, not the same, the similar type of asset amnesty being accepted by our parliament, which is related to the assets having outside of Turkey by the Turkish individual or entities. And the law is saying until end of 2021 June, if those assets declared either to the banks or to the security companies, and bring it after the declaration within the 3 months time, then these assets will not be part of the tax investigation and will not be part of the tax charge. And this is the similar rule since 2002. one thing was quite important, because till 2013, all these asset amnesties, the definition was a little different. But now, since 2013, it is saying that the amount that has been declared and brought into Turkey will not be subject to any tax investigation and any tax charge. And this is the amount that you are bringing into Turkey is not be a part as tax shelter for your past tax liabilities. And as I said, end of June 2021, but the government, or not government anymore, sorry, president has the right, the extent that twice as 6 months. And in my opinion, this amnesty will last till end of June 2022. And again, there is one difference, which this time this amnesty is with zero tax. Last time was with 1%, before that with 2%, before that with 0%, even I remember with 3%, but this time is with 0%. You do not need, or the people getting benefit from this amnesty do not need to pay any tax. And what is the part of these amnesty? What kind of assets? Cash, foreign currency, and the securities like bonds, like equities, even the real estate, not as a part, but the real estate, the value of the real estate after sale, which you have outside of Turkey, bring into Turkey, is also part of this amnesty. There is no relation actually between the automatic exchange of information and this asset amnesty. It is not because of the automatic exchange, at least as we know. And this is unfortunately in Turkey, because we are always against amnesties, a kind of common practice in Turkey. And most of the people, they are expecting having tax amnesty, which mainly in the relation of the increasing of the previous tax basis and getting a kind of limitation of statute for those years. This is not a case this time, but still the expectation is continued. The government or the parliament can get, this kind of tax amnesty again in the near future. Those are really the things I would like. I'm not going into detail to explain about the asset amnesty portion. And now we can go into the questions, if you like. Most of the questions are in relation to the Swiss authorities' information. And maybe we can ask Bertrand and Danute to start answering all, these questions in relation of this part.
Yes, thank you so much, Sedat. A couple of answers with regard to joint accounts, closure of accounts, multiple residencyship, etc. With regard to joint accounts, and that's a perfect illustration of what I just said about the mismatch between the information Turkey may collect from Switzerland versus the information to be inserted in the annual tax return. The full account with regard to a joint account will be reported. So if you take the example of a joint account between a Turkish resident and a resident from another country, the full amounts which need to be reported, as Danute rightly stressed a little bit before, will be exchanged with Turkey, although it might well be that not the entire amounts reported will be attributable to the Turkish tax resident. So there is clearly a mismatch between the two. The full account is reportable in Turkey, while only a portion of that account and a portion of the revenues there are effectively attributable to the Turkish tax resident. So, of course, that may lead to a certain number of difficult situations, I would say, for those taxpayers. With regard to the closure of accounts, the closure itself will be reported. And here it's the right time to stress one thing, and that will answer another question we got also on how far the Turkish tax authorities may try to collect and obtain information from Switzerland. Once the Turkish tax authorities will be made aware of an account of a Turkish tax resident account in Switzerland, even by the closure of an account there, they will most likely try to get backwards financial account information on the basis of the double tax treaty between the two countries and the specific clause of exchange which is contained in that double tax treaty, allowing Turkish tax authorities to ask on a specific case, specific account holder, specific bank, specific taxpayer, financial account information far back to the systematic exchange of information start, I would say. So you have here a nasty or possible nasty combination between the fact that tax authorities in Turkey may be alerted on a specific account with a specific bank via the automatic exchange of information mechanism, while at the same time they will be able, as the case may be, to ask for more information on the historical data maintained with the financial institution in Switzerland, and that is on the basis of the double tax treaty. So that's important to stress at that point of time. With regard to multiple residencyship, there is one thing people need to understand. Banks are financial institutions, reporting financial institutions, unless an exception applies. They have to ensure that the due diligence rules are followed, which means that each and every account, each and every client needs to sign a self-certification. That self-certification will allow the bank to determine in which country the client is tax resident from. That indication will be compared with the data the bank has already collected in the course of the Know Your Customer due diligence rules and the usual Form A, which is the form on which you have to, for AML purposes, anti-money laundering purposes, clients need to confirm that they are the beneficial owner of the funds on a specific account. If there is any indication that the country of residence already known to the bank does not conform with the country of residence indicated in the self-certification, then further questions will be raised, and the client will have to confirm once again in which country he is resident from. And of course, supporting evidence will be asked to make sure that that is a genuine tax residency indicated not only in the self-certification form, but also on AML purposes related forms. So there is a kind of level playing field within the bank between different units where the same country of residence needs to be indicated, whether that is for AML purposes, anti-money laundering purposes, whether that is for CRS purposes, or whether that is related to the operational aspects of the account. And one of those related aspects goes with the fact that if in client visit reports, for example, there is an indication that the client has been met in Turkey and that the client pretends to be resident in the UK, then you have a mismatch. And that will be raised by compliance officers within the bank, asking the banker actually to sort that out, basically. So there must be a coordinated coordination between the different sources of information within the bank, leading to the same result. That's important. For legal entities, you have already from Danute's presentation understood that it is slightly more complex, of course, and further checks will be undertaken by banks, as the case may be. Danute, I don't know whether you want to add something to this.
Yeah, maybe just a few words. You've clearly mentioned the joint accounts, but typically, should we have account holders resident in 2 different countries, that will mean that actually reportings to both countries will go. So, of course, taking into account if both countries are participating jurisdictions. And again, with the whole amount. So, I would say, if there is a case where there is no clarity as to which tax residence is the one applicable to the client, then we will maybe have a case where we will need to report the same client to 2 different countries in case it's not clear. So it is important for clients. So it's not an opportunity for a client to introduce a certain doubt as to which country is his country of residence, because that will trigger 2, 3, or several reportings. Just from a practical point of view, we once had a case where we had some clients that were resident in country 1, and in the middle of the year, they claimed they changed their residence to country number 2. And I said, okay, fine, sign us the document, provide us with proofs. And it happened that actually they were pretending to change their residence, which they didn't. And they couldn't provide us with a proper proof of change of residence, in which case we told them, look, if you are not providing us a real proof plus the right document properly signed, we will not be able to report to the other country, but we will report to the country number 1. So it is, so confusion in these type of scenarios is not a good way out, if I may call it that way. It is very important to have that certainty as to the countries, and I believe on the question on the closing of the account was already mentioned. It is reported. Then I saw a question also on what happens if a dual national, Swiss-Turkish, is resident in Turkey. Will he or she be reported? The answer, I would say, for CRS purposes, the nationality will not be an issue. That was clearly specified. I mean, we will need to identify what the definition of tax residence, and in that particular case, if that dual national is tax resident in Turkey, then it will come into the reporting to Turkey. So it's not because there is this dual national that it will be excluded. And this question also included some, what if there are some companies? Then I would say at the level of the entities, we will need to do the same check. So if, what type of entity it is, if it is an active company or passive or so on, we will report accordingly on the basis that the controlling person, if it is the case, will be a Turkish resident. Then, I don't know if Bertrand, you have another question, another point on that. Otherwise, I think there was a question regarding what an active NFE is. I did mention a few of the scenarios that will qualify an entity as an active non-financial entity. And it is, one of the most common ones is by reason of its income or its assets. So the question was, would the assets qualify as an active? So if the assets are more than less than 50% of the assets of the entity are used to produce passive income, so rewarded on the other way. If most of the assets of the entity are used to produce active revenues, then it could be considered as an active NFE. Of course, the bank will not be able to go and check the balance sheet of the company or so on, but we will trust that the people signing the document and providing this legal and binding information that has some legal consequences to us is telling us the truth. Other than that, there are also other entities that would be considered as a non-financial entity other than by its income or its assets. And I've mentioned very briefly, but are like listed companies or a company related to a listed company or a specific holding entity or startups, non-financial entities, or maybe a liquidating entity. So there are several, and I didn't consider it relevant to go into all those details, but there are several entities that would be considered non-financial entities. For instance, non-for-profit entities would be considered, in most of the cases, active and non-financial entities, regardless of the fact that they would be taxable or not in their country. That's another story. Again, we get to the point where there is a difference between what is reported and what is actually taxable in the country. So it's very important to keep that difference. One question that came about, what about insurance companies? Insurance companies are, most of the cases are included within the definition of a financial institution. Therefore, if an insurance company opens a bank account with a bank who's also a financial institution, most likely they will sign a self-certification stating, we are a financial institution, therefore you don't need to report us, we will do the reporting. I think I've covered more or less a few of the questions. If there is any other missing, Bertrand, I don't know if you have something else.
Thank you, Danute. Thank you, Bertrand. You have covered very well. Now, Baris, there are couple of questions for you, as I see, mainly in relation to the residency and about the bilateral agreement between Turkey and Switzerland, which is you already explained, but would you like to answer this question? Please.
Yeah, as to, there are a couple of questions that were directed particularly to me. So the Turkish Parliament has not ratified bilateral AEOI agreement. We told it Turkey has already notified to the OECD that the exchange will start in 2022, but that's not a publicly available data. That's what we have heard verbally from the officials in the revenue administration, but we can expect it to be published soon. Another question, is there a concept of effective management in Turkey when the main decisions of an offshore company are taken from Turkey? So it's not the local rule. The local rule is what we told, that the commercial enterprises are considered as residents in Turkey if their registered head offices or business head offices are located in Turkey. However, we have a PE, permanent established concept as well. So this can be checked from the permanent establishment perspective, whether any permanent establishment is constituted in Turkey or not. So this can be one of the subjects that we have to dig into detail and analyze it.
Okay, thank you, Baris. There are a couple of questions which I can answer. And one question is mainly related to which we call golden visa or similar type of issues, which some of the countries providing residency, mainly included many European countries, to the foreigners. And if you are getting such kind of resident permit, it doesn't mean that you are a tax resident in that country. Tax residency is a different issue, as Baris explained. Either a couple of benchmarks about that, 183 days or even less, then what's your country that you would like to live, and where is your family, and etc. and etc. And having such kind of permit in the relation of the golden visa does not mean that you are resident in that country. Some other questions. One question is related to the amnesty, which is for the offshore funds, just need to be submitted and repatriate to a Turkish bank, or just need to be declared. I didn't go into detail. The amnesty, asset amnesty regulation is saying that the normal way is to declare and to bring into Turkey these assets. But in case that there is no possibility to bring into Turkey, then a declaration is sufficient for getting benefit from these amnesty. And this was the same thing for the previous amnesties. And if you are asking to the tax authorities what kind of assets are not possible to bring in Turkey, they never answer this question. And we do some interpretation. Mainly, if any assets having an ISIN number and transferable from a bank to another bank, means that they can bring into Turkey. Some private equity funds, those are not transferable. Therefore, if you can just declare, should be enough. The question is related to the investment fund, and investment fund or mutual funds certificates, as far as I know, they are transferable. And for that reason, if they will be a part of this amnesty, they have to be brought into Turkey to a custody account, which will be open in a security company. And most of the people, they are asking that what happened in kind that after bringing into Turkey, if I like to take it back to abroad, which is a different issue. I mean, the amnesty is just asking to bring into Turkey. According to the general rule, anybody can transfer any amount outside of Turkey. There are some information processes, but for the current account transfer or for the asset transfer with Eurobonds or other type of securities, you just do it through a bank. Legally, there is no restriction and no permission process. And as I see in my part, one more issue, again related to the asset amnesty. If these assets declared and bring into Turkey and will be not subject any tax control and etc. said, but in addition to that, those are not be part of the investigation of other regulations like money laundering and etc. Okay, I mean, those are the questions from my part. And one issue, I mean, mostly we answered that one, but the question is, it's a very common question. If we start with 2021 figures, and then this retroactively the past of these accounts will also be reported or not. No, I mean the reporting will be only for 2021 if nothing change, and there will not be any retroactively reporting process for the financial information. Okay, I mean, Baris, do you see anything else? I mean, or Bertrand or Danute?
No, I think from my end, Sedat Bey, but there was a question about the insurance companies. I can say that from a Turkish perspective, the individual pension contracts have been removed from the definition of financial account. I mean, this is specific to the accounts that are held in Turkey, not in Switzerland. That I have, maybe I can add this part in relation to that question, and nothing more from my side as well, other than this.
Okay, yeah, you are right. You are right. I missed that one. Bertrand or Danute, do you have anything else about the questions?
Maybe one word about the use of Swiss companies. Swiss companies are taxable in Switzerland as soon as they have been incorporated according to the Swiss regulation, or when the effective place of management is in Switzerland. So there are two ways to connect company to the Swiss tax landscape, whether that is by incorporation or by the effective place of management, which brings us basically back to where the main strategic decisions are taken for the Swiss company, but also looking at the day-to-day operations and who basically assign over the accounts or account of the Swiss corporation. That's one thing. People need to know that Swiss tax liable company in Switzerland is liable to taxes on the profits. That has changed recently in Switzerland. You have canton by canton different rates applicable, but it is a taxpayer. A Swiss company is a taxpayer in Switzerland, paying taxes on the profits. That's number one. And depending on the canton, some kind of taxes on the capital as well. Number two, to understand that as well, any distribution of profits will generate withholding tax, Swiss withholding tax, which rates relatively high compared to other countries. That is a 35% tax charge, which is basically a prepayment of tax, depending on the classification of the shareholder. Of course, if that is a Swiss taxpayer, the 35% withheld or withhold at source becomes imputable. If the taxpayer / shareholder is a Turkish resident, then the stipulations of the double tax treaty will definitely help to reduce that rate. And if nothing has been said in Turkey about the distribution from the Swiss company to the Turkish taxpayer, shareholder, then of course the 35% becomes final in Switzerland. That's another thing to understand. Now, the shareholder usually holds a position towards the company which is comparable to an account holder versus a bank, meaning that the Swiss company itself will have a reporting duty to Turkey about the valuation of the company, the profits made, and any distributions made to the shareholder. So it's not a way to get around the CRS scope. Definitely not. Also, the type and extent of information exchanged will differ compared to the duty a financial institution like a bank would have. The shareholding, basically, of the Turkish shareholder over the Swiss company will become visible in Turkey. So that's very important to understand. I don't know whether Danute wants to add something on this as well. We have seen a tendency that some fiduciary firms in Switzerland are promoting this solution. It is not a sustainable solution. The account / the valuation of the account will become visible in one way or the other. Danute?
Okay. Thank you, Bertrand. We are, sorry.
Yeah, no. Just two remarks on a question that was raised regarding the information exchanged on reportable data. So there was the question whether it was only their income generated or whether the assets, the assets were reported. So the answer is both. The assets, the income, the interest, all those lines will be reported. So it's not only a final balance, but the lines generating what CRS defines as income, what CRS defines as interest, what it defines as sale of assets, and what it defines as other income, which is not necessarily the same classification as the local law would define income or sale of assets. But I just wanted to specify that. And regarding just a closing point on insurance companies, in Switzerland, as in Turkey, local pension funds are considered non-reporting financial institutions, but that's a pension fund. It's different from the insurance company holding an insurance policy for a client. So those are our financial institutions properly reported. So I hope I've covered the questions.
Thank you, Danute. There are a couple of more questions, but we do not have time. I got already, the remark. And but what we can do that if you send an email to us, then we can answer the questions through an email. I thank you, all of you, and to the audience, to the panelists, again, to the embassy and Chamber of Swiss. And now I would like to pass the word to Arpat Bey for the closing remark. Thank you.
Thank you, Sedat Bey. Actually, thank you. Thank you goes to all speakers and participants of this event. This has been a very fruitful hour and a half discussing automatic exchange, double taxation, residency, and amnesty. I think we've covered close to 30 plus questions coming from the audience. So very interactive session though, and I'm very pleased that we were able to have this set up. As a token of our appreciation to our speakers, we made a minor contribution to the WWF Foundation on your behalf, so this will help supporting some of their common programs, and this is I would say the small gift of the Swiss Chamber of Commerce to you. Thanks again to all attendees for joining us for this last event of the year. We'll be looking forward to meeting you and seeing you, hopefully soon physically, but probably still a couple of months to hold on through webinars. And but we wish you all a pleasant holiday, very happy New Year, and all the best, healthy New Year for 2021. Thanks again to all for joining. Goodbye.
Thanks very much. Goodbye.
Thank you very much. Goodbye.
Thank you. Bye-bye.
Thank you. Bye.